As the late baseball great Yogi Berra famously once said about a red-hot restaurant, nobody goes there anymore. It's too crowded. That's exactly how I feel about the Magnificent Seven, a red-hot group of stocks that are equally crowded. Yet nobody seems to own them anymore. Even on a solid day where the Dow ultimately gained 84 points, S&P edged up 0.1%, Nasdaq advanced 0.29%. So much of the market is about these stocks, 6 of which we've owned for the Travel Trust for some time, which you can follow by joining the CNBC Investing Club. The weightings of Alphabet, Amazon, Apple, Meta Platforms, Microsoft, NVIDIA, and Tesla, when added up, are equal to 29% of the S&P 500. So why shouldn't the index swing with them? Let's go back to Yogi Berra's observation. You have to wonder why so few people actually seem to own any of these stocks. I spend a huge amount of time speaking to investors, probably more than almost anybody on earth, especially young investors. Where I go, rarely do I ever hear anyone who actually owns these stocks. In fact, unless I have a bottle signing for my wife's premium mezcal brand, I don't even meet people who own NVIDIA, despite the fact that I named my rescue mud after the semiconductor giant. Why is that? Well, there are a bunch of reasons. We got to go over. First, let's take the Magnificent Seven as a group. Most of these stocks have high dollar amount prices. Of course, in theory, that shouldn't mean a thing. Just buy one share, a fractional share, even through your broker. But most investors simply aren't willing to do that. They want to buy stocks, and they want to buy stocks under $100. They want it to be like it was in the 1980s, 90s even, when every time a stock went into triple digits, the company would do a 2 or 3 for one split. That way, individuals could buy 10 shares. And that's what people like, real people. But these days, most companies don't either, maybe they don't understand your mindset, or they're catering to the big institutions that prefer high dollar amount stocks because they pay their commission fees on a per share basis. 3 for 1 split, 3 times the commission dollars. Home gamers are sacrificed on the altar of the big money managers. Hey, but you know what they would say? They'd say, we run money for a lot of smaller investors, so it evens out. Unfortunately, even though it's irrational, those high dollar amount prices make it far less likely that individuals, that you, will actually buy any of these stocks. I guess you could say they're too high, so nobody goes there anymore. But beyond the big price tag issue, there are individual reasons why it's so difficult to own each name of the Magnificent Seven. See, there's a vast echo chamber of analysts and media that combine to frighten a huge number of you out of these stocks, no matter what. The amazing companies that I'm talking about here have people trying to scare you out of them every day, from Wall Street to your media. I'm now going to give you the top objections that I hear bears spread endlessly about these stocks, and then I'm going to shoot them down right on the spot.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.